All right, now with those housekeeping items out of the way, I'd like to introduce our presenter, Mary Mitchell. Mary is a senior human resources business advisor with Clark Schaefer Strategic HR, bringing 15 years of HR management experience across industries like financial services, healthcare, manufacturing, and retail. She specializes in building inclusive cultures, streamlining HR processes, and ensuring compliance in such areas as Affordable Care Act requirements, employee relations, and training and development. Mary holds an MBA from Bellarmine University, certifications in DISC behavioral assessment, and multiple senior HR designations. Outside of work, she enjoys traveling, music, and spending time with loved ones. I'll now hand the webinar over to Mary.
Thank you, Aubrey. I'm excited to be here with you all today to talk about the Affordable Care Act reporting needs that your company may have. I'm going to go ahead and just dive right on into the subject matter at hand. If you have any questions, again, feel free to put those in the Q&A chat room. I have someone monitoring those, and we'll be sure to answer those at the end of the session. So who does the Affordable Care Act, or ACA, actually apply to? And this is something that can be a little bit trickier for some of our clients to figure out, right? So mainly it applies to applicable large employer groups. And what is that, right? Any employer with 50 or more full-time and or full-time equivalent employees would be considered an applicable large employer group. Now, a full-time equivalent employee, what that's referring to is basically adding up all of your part-time employees' hours and then figuring out how many of that out of those hours would actually be the equivalent of a full-time worker, right? So we would take all of your part-time workers' hours for a month and then divide that by the full-time number, and that would be your number for full-time equivalent. We'd add that to your full-time regular employees to determine whether or not you have reached that 50 or more number. Now, typically, annual reporting is triggered by your previous year's annual average, and the IRS is going to be looking at the amount of W-2s that you submitted for your organization to determine whether or not you may or may not have actually needed to file for ACA the following year. Now, there is another thing called the aggregated applicable large employer group, and this is based upon the corporate entity's common ownership. So if you have a sister organization or say a parent umbrella organization, you could potentially fall into this aggregated applicable large employer group designation. This is something that I definitely defer to legal every time. I can help you figure out if you're an applicable large employer group, but it gets so into the minutia of contracts and legal details that I always recommend pulling in a lawyer to determine if you have reached an aggregated status. All of these entities underneath this group would file their own forms to the IRS and mark the 1094-C with the applicable sister companies or anything along those lines with their related entity names and FEINs to show that they all go together. Now, the trick with the aggregated applicable large employer group is an individual entity does not need to have 50 or more. It's if all of the entities have 50 or more full-time and full-time equivalent employees. Another thing to keep in mind when it comes to who actually needs to report for the Affordable Care Act is whether or not you're self-insured or fully insured. Now, most organizations nowadays are fully insured, and this is something where you're going to a broker and you are shopping your plans out and seeing what's the most affordable, and say you go through Anthem, just as an example. If you are not administering the benefits yourself, if Anthem is handling all of those pieces for you, you are usually not considered self-funded. However, things like ICRAs or health reimbursement accounts can also be applied as a self-insured plan. So that's something you want to verify in advance, because whether or not you have 50 full-time and full-time equivalent employees or not, if you have self-insured benefit coverage for medical benefits, you are going to have to report for the Affordable Care Act, just on a different form. So more to come on that. Another thing to keep in mind when we're talking about ACA is, what does full-time ACA benefit status truly mean? So when we're saying full-time, we're not talking about your handbook's definition of what a full-time or part-time employee is. We're talking about the Affordable Care Act's very specific definition of what a full-time employee is. And according to the ACA, the current status is going to be designated based off of which measurement period you use. Typically, it's determined by weekly and monthly calculations of whether or not the employee has worked 30 hours or more per week on average and 130 hours or more worked per month. And here's the trigger. We don't have to meet both of these requirements for them to be considered ACA. We just need to be meeting at least one of them to be considered ACA full-time benefit status. If the employee is determined to be full-time per the ACA regulations, coverage should be offered either during the typical new hire enrollment window or during regular open enrollment for the following plan year. If that does not occur and we don't have a waiver on file, technically penalties could incur from the IRS through an ESRP notice. Now, when we talk about medical coverage, there are a few things we want to keep in mind. For it to be considered an Affordable Care Act plan, we need to make sure that our plan includes minimum essential coverage, minimum value, and again, we need to make sure whether or not they are self-insured or fully insured plans. So minimum essential coverage is any insurance plan that meets the ACA requirement for healthcare coverage. There are 5 states that have enacted their own regulations on that for the Affordable Care Act. But essentially, we have to make sure that it meets a certain level of coverage and for, like, say, annual exams and certain women's health care in order for it to be considered minimum essential coverage. Now, minimum value is where you have an employer-sponsored plan where it covers at least 60% of the total allowed cost of benefits that are expected to be incurred under the plan. So if it's less than that, it technically cannot be validated as an ACA applicable plan. You can still offer those plans, but I recommend if you are an applicable large employer group that you do have at least one minimum value plan that you're offering your employees. And again, self-funded versus fully insured plans, this is something that will depend on whether or not you have to actually report for the Affordable Care Act with the IRS at year end. So we have to look at the number of employees, but we also have to look at that status for the plan itself. I always recommend letting the broker do the MEC and MV verifications when shopping for plans, because that is something that they have the systems in place to automatically do those calculations based off of your salary data for your employees. So it's very quick and easy for them to be able to validate that information. Now, I mentioned earlier that there are 2 different ACA measurement methods that we need to use in order to determine that ACA benefit status, whether they're full-time or variable hour. The first one is the monthly measurement period method. Now, in this particular method, you have your measurement period over the month, so you're tracking that individual's hours worked through payroll. You're assessing at the end of the month whether or not they are actually going to, whether or not they are actually going to be considered full-time or part-time. And then it enters the stability period. And the stability period is another month. And it basically is when we've actually offered this benefit coverage. So the key thing to keep in mind with the monthly measurement period method is there is a great deal more administrative burden associated with this, especially if you have a large number of variable hour employees. It does not have a longer stability period, and hours are measured each month. So this is something that you're going to have to do over and over again. The second method, and this is the one that's more commonly used, is the look back measurement period method. And each employee's hours are tracked and averaged over that specific measurement period. And it can be anywhere as long as 3 months to 12 months, right? So you can select how long you want that measurement period to be. I recommend if you have a standard plan to go with the 12 months, simply because it releases that administrative burden for you when it comes to open enrollment and things like that throughout the year. You do have the option for an administration period when it comes to the look back measurement period method. And the assessment or administration period, this is where you can determine whether or not they actually are meeting those ACA full-time benefit status requirements with the hours work that we talked about before. So anyone that meets those requirements would need to be offered coverage during open enrollment. And this administration period can be anywhere between 30 and 90 days. It does include open enrollment typically. And you would make sure that you're offering and extending those benefits as well as assessing that ACA full-time benefit status. Now, the next part is the stability period, and this is where your employees are essentially locked in to their ACA benefit status, right? There can be a few one-off triggers that can allow them to move throughout the year. But once an employee has reached that ACA benefit status for full time, we want to make sure that they are offered benefits for that full stability period. And if we have a 12-month measurement period, we should also have a 12-month stability period. Those timeframes should match. So they are locked in as full-time benefit eligible during that time frame. Now, when we talk about the forms themselves and we get into, are these considered affordable coverage options for our employees? There are a few different safe harbor affordability methods that the Affordable Care Act allows for you to use to show the IRS that, yes, we made sure what we offered was actually considered affordable. So there are three different methods. The first one is the federal poverty level. This one, in all honesty, is the hardest one to reach with the escalating costs in healthcare for medical coverage. It's based off of an employee's annual household income, which is a function of that employee's household size and is adjusted on an annual basis based off of what HHS publishes each year for the annual federal poverty level. For the 2025 tax year, the mainland federal poverty level for a household size of one is $15,650. So we would take that amount, multiply that by 9.02%, which is the affordability rate for this year, and then divide that by 12 months. And that gives us the monthly cost of what an employee would have to pay for employee-only coverage. So if your employee-only coverage for your ACA certified plans is more than $117.64, we know that's not the one we want to use for our safe harbor affordability method. Okay. If it's less, you can absolutely use it. There's also calculations that you can use for prior year's W-2 wages, where we take that box one wage amount from the previous year, multiply that by 9.02% with the adjustment for 12 months or 6 months or however long they were actually with the organization at that time. And that will tell you your monthly cost there for affordability rates. The most common one used is typically rate of pay when we talk about safe harbor affordability methods. And this formula varies for salaried versus hourly employees, but we're really looking at the rate of pay and how much that individual is making in order to determine their affordability status. So there are a few different forms when it comes to reporting for the Affordable Care Act. The first one, the most commonly one talked about, is the 1095-C form for individual employee reporting. This is the form for 2025, or an example of the form. And you can see here on the form itself, we're giving the employee data, our organization's data as the applicable large employer member. And then we're also going to give a breakdown in part 2 of that employee's coverage. Now, there are different codes that the IRS gives for you to code for lines 14 and 16. Line 14 is basically going to tell the employer whether or not tell the IRS whether or not you offered that individual coverage, whether or not they were even eligible for coverage. The line 15 is going to show the dollar amount of employee-only coverage that they have to pay each month. Now, whether or not they enrolled doesn't matter for that particular line. We're putting the lowest cost of employee-only coverage for our ACA certified plan on that particular line. And then for line 16, this is where we are going to tell the IRS whether or not they were in an initial assessment period, whether they were, still going through that new hire period, right? Whether they are terminated mid-month, whether they actually chose to enroll, whether they waived. There are lots of different codes we can use here for that. Now, line 17, we're typically only going to put the zip code in for the employee if the organization offers an HRA or a health reimbursement account option versus as a certified ACA plan, like an ICRA or something like that. Those are becoming more and more popular, and there are additional affordability calculations based off of that individual zip code that have to come into play. Now, the other form that is typically most talked about is the 1094-C form. And this is where the employer is summarizing all of the data that we just talked about for all of their employees to the IRS. So we're basically giving a cover sheet to this large packet of 1095-C forms and saying, here's the summary right up front from the organization. It gives, again, all of the applicable large employer information, so your organization's information, the total number of forms being reported, the total number of employees by month, whether it's full-time or part-time, right? We give both of those totals. And then it also tells the IRS whether you're a member of an aggregated applicable large employer group. So when I say we want to make sure we're giving monthly employee totals, I always say pick a standard day of the month for the count. That makes it easier for you when it comes down to either reporting the data or having to explain it later on if you get an ESRP. I usually go with the first of the month, just pull it straight out of the HRIS system to confirm those totals are correct. Now, I had mentioned for lines 14 and 16 that we have different codes that we can use. And here are some examples, and I'm happy to share cheat sheets with anybody that may need it, but it's also in the 1095-C instruction form. You can see that for line 14, for these examples here, that we have all 1 codes. So everything on line 14 is going to start with the number 1. Typically, if you have an employee that is enrolled in an ACA certified plan or waived, or quite frankly, just eligible for an ACA certified plan, you're going to use code 1E. There are some different examples here depending on your plan that you could use, but 1E is the one that I see most often. 1H would really dictate to the IRS that there was no offer of coverage, whether it was because that individual was not eligible or maybe they had terminated, right, in November. So in December, we're going to say 1H because they were no longer with our organization. One thing that we need to keep in mind that when we use these codes, it needs to apply to the entire month. So say if that individual terminates mid-month and their coverage does not go to the last day of the month, we should be using code 1H for that particular example, saying that coverage was not offered because it was not offered for every single day within that month, right? So 1H is really the only code you would use if it doesn't apply to every day within that month for reporting purposes. When we talk about IRS ACA deadlines, this is something that we all need to keep in mind for the months coming up very soon. All 1095-C forms must be postmarked and mailed to employees by March 2nd of 2026. So as long as it's postmarked by March 2nd, we're good to go for all of those forms going out to employees. Now, employer electronic filings of the 1094-C and 1095-C forms are due to the IRS by March 31st, 2026. And any employer mailings physical mailings that are actually being sent to the IRS are due by February 28th, 2026. Now, technically, you can also file for a reporting extension if need be. Say this is the first year you all are having to do it. You can definitely file for an extension if you need some more time for the reporting data. Now, when we talk about the physical mailings for the February 28th deadline, that is only if you have 10 or less forms. So if you have more than 10 1095Cs or 1095B as in boys, which is another form type that you can use if you're self-insured but don't meet that ALE or applicable large employer group status, then you can electronically file. But if you have 10 or less, you can still do a paper filing. You can see here up on the screen, and this is also in the 1095C instructions, that it does give you that information. So if you do need to paper file, you can absolutely do so. It's just going to depend on your state as to which one it goes to, because there are two different Department of Treasury locations that you can send that packet off to. Now, I get asked quite often, what if I have to correct one of my 1095C or 1094C forms, right? What do I have to do? So there is a spot on the form where you can actually mark the corrected box up at the top, or void if it's something that shouldn't have been filed, on the top right of that form. You make the necessary corrections on the file. You then have to create a corrected 1094C form as well. This will be the new authoritative transmittal, and this tells the IRS that this is, in fact, the most up-to-date version that they should be looking at. You want to send all of the corrected 1095C forms with the new authoritative transmittal 1094C form to the IRS, but you don't have to send all of the 1095Cs that were correct that you sent previously. And obviously, if you do a corrected form, please don't forget to mail an updated version out to your employee. So a lot of times I get asked about ESRP notices or IRS penalties. What are they? How do we incur them? How do we avoid them? Right? There are two different main types of penalties that the IRS has for ACA, either errors in filing or not being handled appropriately. The first is under Section 4980HA, and this is issued to applicable large employer groups that fail to offer minimum essential coverage to at least 95% of their full-time employees, as well as their dependents. They are expected to be $2,900 per employee, or $241.67 a month for the 2025 reporting year. Because every time every month that it takes you to actually show that you did not offer or did offer that coverage, they're going to ding you for that. And it's going to have interest accrue over time. The assessed amount will deduct 30 full-time employees from the total number of full-time employees when it's doing the calculation. If you ever run into an issue with this, or honestly either one of the type of penalties, please reach out. We can absolutely assist you when it comes to responding to these ESRPs and seeing if we can either have them eliminated or reduced if it was just a filing error. The second penalty type is the 4980HB penalty, and this is the one that I actually see most often. This is issued per each employee that receives a premium tax credit or subsidy from a state or federal ACA marketplace exchange when the ALE does not offer a coverage option that meets the affordability threshold. It is expected to be $4,350 per employee, or $362.50 a month for the 2025 reporting year. This one's definitely more expensive. I will say, coming in 2026, there will be much fewer subsidies granted based off of the legislation that has recently gone through. More to come on that, I'm sure, if that changes soon. But because there will be fewer subsidies granted, there are less likely to have ESRP penalties associated with that moving forward. Now, you can still get them for any of your historical years, including 2025. But moving forward, there should not be as many of those going out for 2026 onward. So I know I just gave a whole lot of information, but I want to make sure we take time for questions because that's usually where I feel like you all get the most benefit out of this particular webinar. So I want to open this up to any questions you all may have.
Thank you, Mary. Very helpful. Great information. There's a couple of questions that have come in. Let's start maybe with an easy one, hopefully.
Okay.
So if employers are, or if employees can access their form in their payroll system, so if you're using ADP or Paycor or something
Yes.
to actually do it, do the forms still have to be mailed?
Technically, no. As long as that individual or the company has it set up where they are paperless and the employee, when they're onboarded, knows that they are a paperless organization and they have to go into the system, you do not actually have to physically mail those out. But you do need to make sure they're available in the system for them to download.
Perfect. Very good. Now let's get a little more complicated. We're going to go back to talking about stability periods.
Yes.
Very confusing to many.
Yes.
So one of the questions that came in regarding the stability period, does this example mean that the employee should keep his benefits? And so they've got a very specific question, but I think it's helpful to kind of hear a real life situation, right?
Absolutely.
So the employer uses a 12-month look back period.
Okay.
Right? So they're doing the 12-month. The employee is full-time for 10 months, and then they drop down to part-time.
Yes.
So 10 months they're full-time, 2 months they're part-time. Does the individual stay on benefits while they're part-time? And then their status changes to, like a qualified eligible under COBRA?
Mm-hmm. So technically, for that stability period, they would still be considered benefit eligible. Now, having said that, most people that switch over to part-time, right, even though they have the ACA full-time benefit status for eligibility, choose not to continue being enrolled in the benefits because they're making less money, so they don't want to have to pay for those benefits on top of it. And usually, when you can drop down to part-time like that, there's maybe another way that you're getting your benefits, right? Maybe through a spouse or something along those lines. But technically, yes, the company would still need to offer those benefits. Now, if they were full-time for 10 months, more than likely for your next year, they're also going to come up as ACA full-time benefit status. So that's something to keep in mind. I would have that conversation with the employee to say, hey, do you still want to be enrolled in this? It does cost money, right, for you to continue to still be enrolled in this. I'm assuming very few people I've met nowadays have a $0 plan contribution that they have to pay for. Awesome if you do, but most will not continue to be enrolled in those benefit plans. But technically, for the Affordable Care Act, they are still considered full-time ACA benefit status, and the company should be offering them that benefit coverage.
Great. What if you reverse it? What if it's they're full-time for 2 months and then are part-time for the other 10 months? Same situation with a 12-month look-back period?
Same situation. Yeah.
Okay.
Same situation. But obviously then for the following year, they would more than likely come back as part-time.
Very good. So that almost might encourage people to use a monthly measurement period. Is that true? Even though it's complicated? Yeah.
It depends. Honestly, if you have a large number of variable hour employees, it is extremely burdensome from an administrative perspective to do a monthly measurement period method. Just because you're going to have to calculate that every single month, extend benefits for an open enrollment every single month. So that is a lot of work to do. I'm saying this as a HR professional that is in the midst of multiple open enrollment periods for my clients. That is a lot of work to do month over month, right? So that is something to consider. And that usually turns people away from the monthly measurement period method.
Gotcha. Yeah, burdensome for sure.
Yes. Yes.
Another question that came through, if a variable hour employee trended. I'm not sure I understand that question specifically, but they're basically asking about a stability period and, requiring the continuation of medical insurance. They're asking, do you have to offer all full-time benefits or just medical? And ACA only applies to medical, correct?
Correct. So really, we're only concerned with medical plans when we're talking about the Affordable Care Act. It is entirely up to the employer if they want to extend other benefits out to part-time individuals. Some choose to. Very few that I have as clients typically do that just because it's cost prohibitive. But if you have the ability to do that, that's wonderful, but you don't have to. Medical's really all we're concerned about here.
Got it. Perfect. Someone's asking if you have a waiver for 2026, is it okay to have a passive enrollment instead, or do you actually need the physical waiver?
So if you are doing a passive open enrollment, you should still be there should still be waivers in your system, right? So whether that employee logs into the HRAS to actually complete it, or they just let it continue being what they're enrolled in, the system will automatically note whether or not that person chose to waive that coverage. So you would have that waiver whether it's an active enrollment or a passive enrollment. Does that make sense?
Yeah. Yes.
If we're not using an HRAS, I'm going to say we still want to get that waiver. We're going to have to take that paper form to the individual and get them to sign off on it.
Because if you do get a notice, you have to be able to prove, right?
Exactly. We need to prove that they did actually waive the coverage.
Perfect. What is the special rule? After 3 months, can they drop benefits in the stability period?
The special rule.
I was hoping you knew what that meant. What is the special rule? No. Okay. All right.
Okay.
We're gonna pass on that if someone wants to clarify what that question is.
I'm going to assume that we're talking about certain institutions that are allowed to, like educators, as an example, for schools. If they have a summer break, they are allowed to have a certain amount of weeks that they are off work and still considered benefit eligible. So there's a certain number of weeks that even if they typically, are not actively working because they have a summer break or a break in their period of actual work, they're still technically employed and can be considered full-time still. I'm assuming that's what we're talking about here, but I could be wrong.
Thank you for that. I appreciate it.
Yeah.
You mentioned HRAs, HSAs, and ICRAs as being considered self-insured.
Yes.
Are there other plans like that that are included? Since FSA is employee money, it does not apply, correct?
Right. Correct. Absolutely. So FSAs and HSAs, so health savings accounts, do not count towards what we're referring to here. But ICRAs or HRA or health reimbursement accounts that are certified as ACA plans would be considered self-insured. Now, you can also just have a standard self-insured plan. That is also something that is out there, but you would know if you were a self-insured plan, right? So the ICRAs and the HRAs are the only ones that people typically get confused on.
What if an employer has a high deductible healthcare plan, like just a traditional, high deductible, and then they offer a secondary HRA to help with deductible expenses? Are they then considered self-insured?
If their high deductible health plan meets the affordability standards for the Affordable Care Act, then they can just report based off of the HDHP plan. Yeah, they don't have to do all of the additional calculations for the HRA, even if the employee chooses to enroll in that.
Great. Okay. Two questions, two different questions kind of from newbies. What is your best advice for someone doing this for the first time? the organization that they were using no longer offers the service. So looking for advice on how to start. And then similar, I need ACA 101 training. Any suggestions?
Those are great questions. So, so I honestly offer that service through Clark Schaefer Strategic HR, as Patty knows. So we have multiple formats, and we are happy to help you with your reporting as a client. We would gather the information for you, and we have a few different versions of how we do this. We could either do it where we're handling all of the coding and everything, or we could do it where you're actually doing the coding and we're coaching you throughout that process so that you learn how to do it. And then we just handle the electronic filing portion for you with a compliance review. We also have it where some of our clients are just literally saying, I'll do the coding, but I want you to still review it for compliance and then do the electronic filing. So we have a few different versions of how we can help you in that particular service line, and we are happy to do those things. For those clients that choose to go with I want to code, but I need the coaching along the way, I basically give them an ACA 101 throughout that particular process.
Great. And you're a great teacher, so that's wonderful.
I try to be.
Let's go back to the 9.02%.
Yes.
In that calculation, is that is it applicable to the lowest person's hourly rate on our payroll?
Yes.
Yeah.
Yes, absolutely. That is 9.02% is the affordability percentage for 2025. And it does change year over year. They will publish a new affordability percentage based off of the economy and cost of living and all of those different factors. So I've seen some years where, it was 9.65%. I've seen years where it was 8.93%, right? It just kind of depends. But they will tell you in advance what that year's affordability percentage is. And for 2025, it is 9.02%.
Is the Paper Reduction Act still in place, not requiring employers to mail the 1095-C forms to employees?
As long as you have an electronic version that the employees have access to, yes. But just like W-2s, if they don't have a way to access that electronically, we still have to make sure that that gets delivered.
We are a small company, 14 total. Only 5 on the insurance plan. Are individual plans considered the same as group health plans and requires you to file?
If it's considered self-insured, then yes, we would need to make sure that we still file. We would just be using the 1095B as in boy and 1094B forms instead of the 1095C and 1094C. Now, having said that, some benefit providers, not all, but some benefit providers will handle those smaller groups for your ACA filing. So I would definitely check with your benefit provider or your broker to see if that is something that they would handle for you on your behalf.
Okay. I'm sorry, there's just tons of questions, Mary. I apologize.
No, I love it. I love it.
Summer interns working full-time hours for a 3-month period are not required to be offered coverage, correct? Question mark?
If you are using a look-back measurement method for a full 12-month cycle, they are not going to meet the ACA full-time benefit status requirements. So that is correct. However, if they are not being hired on as temp with a firm termination date, I've had some examples where individuals are considered seasonal, but at the end of the day, they never actually stopped working. They still, they were still kept on board. We would have to just keep a very close eye on those type of situations and make sure we're offering benefits if that person does in fact stay on and continue to work those hours.
Perfect. What if we offer an HRA to our retirees over age 65 who don't get medical? Do we need to report that? So an HR plan for retirees.
Yes, you would need to report those. Now, typically, those are managed under a different set of benefit plan options where the benefit provider will handle that reporting for you. So that is something I would check on first before you dive fully into, oh my gosh, no, I have to handle all of this reporting for my retirees. I would check with your benefit provider first to see if they're actually handling that.
Hopefully they are.
Yes, yes.
For the affordability calculation, should the total be compared to our rates with or without wellness credits? Oh, good question. Is it the base rate? Yeah.
Yep, the base rate. The base rate. I say that assuming that their wellness credits don't apply to every month within that year. Now, if they are getting wellness credits for every single month within that benefit plan year, then yes, you can use the wellness credits because that is genuinely the lowest cost of insurance that they're expected to pay. But if it fluctuates based off of your wellness credits, which I've seen that be the more common situation, then we would want to go with the baseline for your affordability calculation rather than the wellness credit number.
They clarified and said yes. If they complete requirements to get the credits, it does apply all year round.
Then they can absolutely use that number.
Okay. Amanda, I might need clarification. It says, do you report it once if you provide them a buyout on retirees? I'm not sure I understand.
So when you do a buyout with retirees, they are technically no longer employed and would not be obtaining that ACA benefit status of full-time. So we would not need to report for that in that situation.
Got it.
So this is mainly, again, for anyone that was actively employed within that year, or if you're self-funded, anyone that was on your COBRA as well.
Got it. Yeah.
These are some great questions this year.
Aren't they
I
good
love
questions?
it.
They're so
They
good.
are.
What is the most common mistake in ACA reporting?
The most common mistake that I typically see is where people are putting that their organization offered the coverage, where the employee chose not to enroll, but they don't have that benefit waiver on file. So then they get hit with the ESRP notice and additional penalties, and they don't have a way to prove that they did in fact offer that coverage to that employee and that they chose to waive.
So make sure you're accurate.
Yeah. Yeah. Make sure you have those benefit waivers on file, whatever you do.
Yeah. Do you restart the measurement period for a rehired employee? So if someone leaves and then comes back in the same year, do you restart the measurement period?
If it's within the same stability period year, no.
Okay. Good. I think I've gotten through all the questions, if you can believe that. Let me double check. We've got them at a couple of different places. Mary, you've been incredible. We bounce these questions at you and you just know the answers. So thank you so much. It's wonderful.
I try to. Sometimes they stump me, right? And I need additional details. But I will say that if there were any questions that I did not answer fully or that you're fully understanding, please don't hesitate to reach out to Patty or I. We are happy to answer any questions and see if there's anything we can do to help you along your ACA reporting journey.
What's considered?
Did we have another one come in?
Yeah, one more. Sorry.
It's okay.
Some of our interns work full-time during a short period, 3 to 4 months, and then they go to part-time basis, typically less than 20 hours. Do they need to be offered benefits at open enrollment when they are working part-time? depend on their stability period, right?
Right. It would depend on your stability period. But I will say, typically interns are still in college and they usually have benefits either through their parents or through their school. So they're not usually interested in company benefits. So there's one win in your favor, right? So you don't have to worry about that as much, but depending on your stability period, you may still need to offer them coverage.
Someone re-put a question in, but you've already addressed this one. The small company, 14 total, only 5 are on an insurance plan. Are individual plans considered the same as group health plans? And you already addressed that one. So if we weren't clear on that, please reach out to us and we'll make sure that we clarify that.
And I will say that individual plans are separate from group health plans, so you shouldn't have any worries there.
And then if multiple organizations are using the same health plan, but are all separate companies, how are the rules defined to determine if they would need to be aggregated as one large group rather than individual companies? I think I heard you say ask an attorney. No.
Yes, I would say defer to legal, but if you are on separate EINs, FEINs, right, and your legal separate entities that are reporting your W-2s separately to the IRS, more than likely you are going to fall to different reporting structures individually by FEIN. And on the 1094C page 2, page 3, you would actually list out the other entities that you're associated with.
If an HSA is employer funded, is it treated differently than if it's employee funded?
Honestly, no. And the HSA would have no effect whatsoever on your ACA reporting. It would just be for the high deductible health plan that it's tied to.
Yeah. Okay. Great. I think I've gotten through them all.
Awesome.
Thank you, Mary.
Thank you all for being so participative and putting questions out there. I love doing this part of the webinar.
All right. Well, on behalf of Clark Schaefer Hackett and Clark Schaefer Strategic HR, thank you for attending our webinar. If you have any questions, please reach out to Mary or Patty or contact us at info@strategichrinc.com.